The supply chain breakdown is causing a lot of the inflation we see. And everyone's like, wait a second, why are you talking about deflation? That's coming next. People are not ready for it. I know the inflation's here. I buy gasoline. I shop in the grocery store. I get it. It's persistent. It's not transitory. I understand all that. But inflation has two major sources. One is the supply side, which is called cost push inflation. So that's energy price shocks, fertilizer shortages, strategic metal shortages, component suppliers who can't deliver stuff to factories in Germany and they're shutting down, et cetera. The other cause is from the demand side, and that's called demand pull inflation. Basically, it's psychological. Consumers pull demand forward. They're like, hey, I was thinking of buying a refrigerator. I better buy it today because the price is going to go up in 6 months.
We will now bring you clips from the interview. Please watch, share, and like this video. Also, ensure you subscribe to the channel, turn on post notifications, and share your thoughts about the video in the comments section below. Thanks and enjoy the video. The renowned economist Jim Rickards continued her speech as follows.
In the 70s, we had both. It started with cost push with the Arab oil embargo, but it ended up demand pull. I was starting my career at the time. Your boss would just give you a raise. You didn't even have to ask. Inflation was going up so fast. Like, I better give this guy a raise. Like, here's another, $30,000 or whatever, because people would quit, and that sort of spun out of control until Volcker squashed it all. Right now, we do not have demand pull inflation. We do have cost push inflation. The difference is hugely important because cost push inflation from the supply side, it's real, prices go up, but it's self-negating. The old saying that, the cure for higher oil prices is higher oil prices, because when they get too high, people stop driving. They shut down various activities. By the way, if you're unemployed, you're not buying any gasoline because you're not going anywhere. That's kind of a nasty way of putting it, but that's how cost push inflation tips into a recession and then prices come down. And we saw that in 1974. You had Jerry Ford and Alan Greenspan walking around with they had these win buttons, WIN, which stood for whip inflation now, except we had a recession and prices collapsed. Now, it came back by 77 for a lot of reasons, but right now we don't have demand pull, we have cost push. It will go away when this economy goes into recession. And then we're going to be talking about disinflation and deflation, which are, kind of close cousins. And the Fed's going to be out on a limb as usual, raising rates in the face of a recession and a price collapse. I don't know what the recession is a cure for. It's coming. The recession is coming. And Jay Powell said this. Jay Powell gave two speeches, August 26th, Jackson Hole, and September 21st at the press conference after the FOMC meeting that day. And the September 21st speech was almost like, well, just in case you weren't listening to me in Jackson Hole, let me tell you again what's happening. And then Jackson Hole, he was like Nancy Pelosi. He tore up a speech and wrote a new one, like literally the day before. It was 3 or 4 pages. It was really short. He used the word pain 3 times in one paragraph. I've been following Fed news for 45 years. I've never seen the word pain ever. But he basically said the same thing. But September 21st, he was even more blunt. He said, there's going to be a recession. It's going to be bad. Unemployment is going to go up. Get it straight. These things are going to happen. And that's what it's going to take to get inflation under control. But he went on and on about how inflation was job one, because the Fed has this dual mandate, which never made sense, but it's the law. Humphrey Hawkins. The dual mandate is price stability and low unemployment. Those two things don't always go together. And sometimes you got to make trade-offs between the two. But right now, the trade-off is very easy, which is unemployment's really low. Now, I don't put much weight on it, but the Fed does. Again, put your Fed hat on. Unemployment's really low. If unemployment went from 3.5 at the moment, if it went to 4.5, 4.9, is that the end of the world? Well, that was considered pretty low in 2013 when they were doing QE4 or whatever. So they're willing to do that. And they also think the recession, if it comes, will be mild. But those two things together will get inflation under control.
The renowned economist Jim Rickards continued her speech as follows. In the statement from Powell, indicated he didn't express that. Their focus is on the core PCE, the Personal Consumption Expenditure Price Index, core, meaning excluding food and energy, and everyone's like, why would you exclude food and energy? Once again, I'm not here to argue about it. That's their approach. They aim to achieve a 2% core PCE annually. Powell didn't mention that we're going to increase rates until core PCE is 2%. He didn't say that. What he stated was that we'll raise rates until it has a constraining effect on inflation, and inflation will naturally decrease because rates will be sufficiently high to prompt that, at which point we, the Federal Reserve, will pause. Then you ask, well, when will you lower rates? He was like, the pause could last a year. So you're talking. TW. Let go of this Fed policy change nonsense. I mean, you're talking about 2024 before they reduce rates. It's similar to what I recall from Vietnam, the old saying, you know, we had to devastate the village to preserve it. We have to damage the economy to rescue it. This is the most recent in a long series of Federal Reserve missteps since 1913. It seems to be their specialty, but that's what they're doing. And on top of all that, there's an impending global liquidity crisis, a worldwide financial crisis that differs from a recession. It's a financial panic, and recessions are distinct events. They can occur independently. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. They can coincide. It appears they might be coinciding again. This is evident in inverted yield curves. Major dealers are competing in auctions for treasury bills. The Fed will provide you with treasury bills with a single phone call. All you have to do is contact the Fed and conduct a reverse repo. They'll provide you with some treasury bills. However, banks are bidding in auctions for treasury bills that yield a maturity lower than what the Fed will provide with a phone call. Why would they do that? The explanation is that the Fed bills cannot be rehypothecated. They cannot be used as collateral. However, the auctioned bills can. This indicates there's a collateral shortage. This implies reducing balance sheets, financial distress. And we also observe it not only in the Treasury yield curve, which is inverted from 6 months to 10 years at present, but also in the Eurodollar futures curve, which is even more concerning. It's not unprecedented, but it is rare, and it's not a good sign. Nevertheless, the Fed persists in raising rates despite this extremely unfavorable data. So, I anticipate a significant recession in the US, and the global outlook is fairly grim. Moreover, there's the possibility of a global financial liquidity crisis worse than 2008. If all I've said is accurate, which I believe it is, or I wouldn't be stating it, they could, at the very least, take a break now or even reduce rates. But if we're on the brink of a global liquidity crisis, as indicated by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with a yield at maturity below what the Fed will provide with a phone call. I mean, all these developments are taking place. That's hard data, and it's a very, very concerning sign. Less evident in 2008, incidentally, prior to the Lehman Brothers collapse. So, with the economy naturally entering a recession, along with the brewing global liquidity crisis, why on earth is the Fed raising rates at all? That's unsustainable. So I foresee a more severe recession. That's one aspect, combined with Fed tightening, interest rate increases, balance sheet reductions, and so on. That's one whole dimension, and I wouldn't place much weight on a low unemployment rate. It disregards the labor force participation rate, which is abysmal. You know, it's around 62%, compared to 70% in the year 2000. However, unemployment is a lagging indicator. Unemployment rises after a recession begins. Employers are very reluctant to lay off employees. You have to pay severance. Recruiting and rehiring them and providing training is costly. Employers typically wait until the recession has already commenced, and they say, oh, well, I have to lay off some people. So it's not a leading indicator, it's a lagging one.
Don't forget to like our video and subscribe for our channel.
The Fed will not be able to get interest rates to 5% without causing recession, not to mention the impact on the deficit and a lot of other things. So the Fed can't escape the room. So if inflation stays where it is, the Fed can't get interest rates to a real level without causing recession, which will sink the stock market. But even if inflation comes down a little bit, that'll be a sign of recession. So you're raising rates into a recession, which will cause a recession. You end up in a recession either way. It's just a question of whether the Fed persists or throws in the towel. Now, we've seen this movie before. What's going on is an exact replay of what happened between 2013 and 2019. May 2013, Bernanke announces the taper. Expectation is they're going to start the taper in September. He chickens out. They start the taper in November 2013. They finish the taper in November 2014. Then here comes Yellen. She's going to raise rates. Take out the word patient from the statement. She doesn't raise rates until December 2015. And then she doesn't raise them again until December 2016. They went a whole year between two 25 basis point rate cuts. And then here comes Powell, and then boom, okay, 25 basis points, boom, 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 gets them up to 2.25, which is where they want it to be, and gets the balance sheet down to about $3.5 trillion. They want to get it down to about $2.5 trillion. But he's got rates about where he wants them. He's got the balance sheet on its way down, and he's normalizing. And what happens? The stock market crashes 20% between October 1st, 2018 and December 24th, 2018. That was the famous Christmas Eve massacre where the stock market fell 3% in one day. But the Fed's still tightening. The Fed tightened like a week before the Christmas Eve massacre. They tightened into the weakness. They were getting very close to crashing the stock market. They took it down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out. Okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE. I forget if it was 8 or 9, whatever. Lost track of QE. He starts QE 8, let's say. And then that takes you into 2020. And here comes the pandemic, and rates go down to 0. And the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen. And it's not clear which, but it's going to be one or the other. They're going to keep tightening and keep tightening and keep tightening, try to get a handle on inflation and crash the stock market. Or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November. But the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either because the Fed doesn't drill for oil. They don't build pipelines and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here. The supply chains are getting worse. But these supply chain disruptions didn't start with the war. They didn't even start with the pandemic. They started with Trump's trade war beginning in 2018. I found a very good book on that written by Lorianne LaRocco. And what's interesting about her book is that she finished it in late 2019. So it's almost like a controlled experiment. It was pre-pandemic. It's easy to say that the pandemic disrupted the supply chain, which it did, and the war disrupted the supply chain, which it did. But here we have a very rigorous study of what was happening to supply chains before either one. And the answer is they were a mess. They were a mess back then because of tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That sounds easy because Brazil grows soybeans. Well, guess what? You got to get the ships to Brazilian ports. You got to rearrange all the logistics lanes. That was happening already. Pandemic made it worse, and now the war makes it even worse than that. Yeah, the world is breaking up. We're decoupling. Globalization is over. There'll be a new form of it. It's not the end of world trade, but you're going to see maybe the Five Eyes, UK, US, Canada, Australia, New Zealand, and friends in Western Europe form a new trading bloc, but exclude China and Russia. It'll be a little bit more like the Cold War. I talked to Paul Volcker about this, but here's what happened in the 70s. Now, it started as cost push inflation. It was the Arab oil embargo in 1973, after the 1973 war, the Israel-Arab war. Then the Arabs threw the embargo on us. The price of oil quadrupled. It went from $3 a barrel to $12 a barrel. It sounds cheap, but that's a 300% increase. And then we had a severe stock market crash and recession in 1974, which at the time was the worst since the Great Depression. We've had worse ones since, but at the time, that was the worst recession since the Great Depression. Then we come out of that, and along comes the Fed, and we went off the gold standard. Nixon had an easy monetary policy in 72. It was a little earlier for his reelection effort, et cetera. So here comes the inflation. But what happened along the way, and then you had another Arab oil, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were double oil shocks. That was supply-driven cost push inflation. But along the way, it morphed into demand pull. It morphed into a demand-driven inflation. Now, I lived through it. I mean, I was a young, up-and-coming lawyer at Citibank and a senior officer living in New York City. And that was the world where if you wanted anything, new furniture, TV set, vacation, whatever, you dropped everything, ran out and did it because the price was going up so fast. So that's instructive in two ways. Number one, it shows that the Fed's always behind the curve. It shows that these things can persist a lot longer than people expect. But in my view, most importantly, because I think things are going to happen more quickly now, it shows inflation morphing from cost push to demand pull, morphing from something on the supply side to a psychological shift on the consumer side. And Volcker crushed it, but at a huge cost. Unemployment was about 11%. He took interest rates to 20%. How does that feel? Mortgagors and student loan holders and others, 20%. You talk about 40% on credit cards in that world. And people forget, doesn't inflation, don't you have high growth or whatever, at least, or low unemployment? No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We had 3, 1974, 1980, and 1981, which lasted until 1982. And by the way, people lost confidence in the dollar. In the late 70s, Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now, it was Treasury debt. You had the Treasury credit, but it was denominated in Swiss francs because nobody wanted dollars. That's how bad things were.
The thing I would point out is that there are bull markets and bear markets, and in basically any tradable instrument or commodity, or I consider gold to be a form of money. But what we're really talking about when we say, gold is up, what we're talking about the dollar price of gold. And I view it as a cross exchange rate. People talk about the dollar, the euro dollar exchange rate. Well, there's a dollar gold exchange rate, and that's the dollar price of gold. So there's just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar. But the first great bull market was 1971 to 1980. Lasted 9 years, and gold went up 2,200%. The second great bull market was from 1999 to 2011. Gold went up at just a little under 700%. But in between, you had a bear market from 1980 to 1999. So a long one, almost 20 years. Gold dropped from $800 to $250 at the bottom in 1999. And we had a second bear market starting in 2011. Now, I had a very interesting conversation with Jim Rogers. Jim is one of the great commodity traders, money managers of all times. And we were down in Dominican Republic at Casa de Campo. This is around 2014, but the bear market started in 2011, but it really fell off a cliff in 2013. So I said, Jim, what do you think of gold? What are you doing? He goes, well, I own it, of course. And he said, I'm not selling, but I'm not buying right here. And he said something that just hit me right between the eyes and it stayed with me. And of course, he's right. He said, gold's going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time. But if you look at that drop down and you use $250 as your base because you need a base. So you had basically the run from 250 to 1900 was $1,750. Go down 50% from there, it's $825. 1900 minus 825 is 1075, and the bottom was 1050. So Jim totally stuck the landing. Like at 1050, like, okay, there's your 50% retracement. Now that's the bottom. Now it's going up, and the sky's the limit. Well, we're not overheated at all. I've got gold at I would put it at $15,000 an ounce before 2025. But as I point out, if you're going to $15,000 an ounce, you got to get to 3,000, 5,000, 7,000 first. So there's plenty of room to run, plenty of room for profits. But when I say things like that, I want to be clear. There's a lot of analysis behind it. I don't just pull a big number out of the air and for publicity, because I could care less. But if you just took the average, and there are a couple ways to think about it. Just take the average of the two prior bull markets I mentioned. So 71 to 80, 9 years, 2,200%. 99 to 2011, a 12-year bull market, about 700%. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, well, the next bull market is going to be a little over 10 years, and it's going to go up. It's going to go up 1,500%. So using that as your base, just take the average of the two. You say, all right, 10 years from 2015, that puts you out to 2025, and at 1,400%, it puts you at $15,000 an ounce off a 1050 base. So that's just history. But there are other ways to think about it. Now, I don't know if there'll be a gold standard or not, but I do know that gold will move. The price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed. If you just took the money supply, so just take M1, which is a pretty widely accepted definition of money supply. Take it for the U.S., the ECB, UK, Bank of Japan, and People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there. Divide that number by the official gold, which is about 34,000 metric tons, a little bit less, you come to $15,000 an ounce. So if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 an ounce. So what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use a rigorous calculation, what's the implied non-deflationary price? Interestingly, they come out in the same place. I don't think they have to. They're two different methods, but they both point to $15,000 an ounce sometime over the next 3 or 4 years. It is a moving target. The numbers I gave you were based on current levels, but if you keep printing money, you need a higher price if you want to reference gold and not cause deflation, which they don't. You're going to need a progressively higher price of gold. One thing people forget, they look at the dollar price in absolute dollars. So it went up $100 an ounce, or I expect before long it'll go up $1,000 an ounce a week. But each dollar increase is a smaller percentage increase. So people look at the dollar. Yeah, it's real money. It's nice to make the money. But if you go from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. I mean, you can do that in a week. So my point is, it's still $1,000 an ounce, good for the holders, but the percentage increase gets smaller and smaller as the absolute dollar amount gets larger and larger. So $15,000 sounds like a big number from today's perspective, but as you go to 10, 11, 12, it gets to be a progressively smaller percentage increase, and therefore more likely. You need to see it logarithmically to see it, a less hyperbolic curve. So logarithmically is the right way to think about it, but in dollar terms, the percentage increase gets to be pretty small at those levels. And when I say $15,000 an ounce, I don't think I'm stretching. I mean, could it be 25,000, 40,000? I mean, just take my monetary equivalent. If you use M2, and by the way, when I used M1 and did that math, that's with 40% backing, because historically 40% has been a high level of backing. If you take M2 at 100% backing, you get to 50,000 an ounce in a heartbeat. My numbers, I think, are conservative. They could be much higher. But the thing I would point out is that the Fed dug a hole and they can't get out of it. And I said in well, all along, but certainly, 2014, 2015, et cetera, as they did the taper and then they did the lift off and then they raised rates and all that. I said the Fed is trying to get out of this. They're trying to normalize the balance sheet, trying to normalize interest rates. But I also said they won't be able to do it. And that's exactly what happened in the fourth quarter of 2018. Between October 1st and December 24th, 2018, the stock market dropped 19%. It was 1 point away from a bear market at that stage. And then you had the Christmas Eve massacre. And that's when Jay Powell threw in the towel. He got religion. He said, okay, first he said, we're not going to raise rates anymore. Then he said, we're on pause. Then he said, we're actually going to cut rates. And then 9 months later, he said, we're going to end quantitative tightening, which was reducing the balance, the money supply. And then in September 2019, they started QE4, which is that was before before the recession, before the depression, before the pandemic. They were already in QE4 and cutting rates again. So they can't get out of it. Now it's worse. So they prove that the failures manifest. They prove that they can't get out of it. And what can they do? By the way, on monetary theory, I mean, you say, what's the secret behind I think it's garbage, by the way, but you say, what's the secret behind it? Well, the secret behind it is if you can issue debt and collect taxes in the money that you print, you can force people to accept the money because they need the money to pay their taxes. And if they don't pay the taxes, they end up in jail. Now you can get extensions or do whatever, but at the end of the day, if you manifestly refuse to pay your taxes, they will come and put you in jail. And the point is, it relies on state power. It's really a neo-fascist concept. It relies on coercion, the point of a gun, jails, and state power to enforce the confidence in money. Now and they say that. I mean, I've read Stephanie Kelton. She's the bright light. I mean, this goes back a long way, but I've met her, read her books and her book, I should say, and her articles. But they're very explicit about that. Now, I think that's completely wrong because there are so many workarounds and so many ways to get out from under that kind of state power. But they do rely on state power at the end of the day. So that's why it has this neo-fascist element. The supply chain was breaking down before COVID. Now, of course, COVID made it worse, yes. And the war in Ukraine made it worse yet, yes. But this really started with Trump's trade war in 2018. So that, like I said, there's a thread that runs through all these things. So not to throw out my hands, I'm not going to do that. But when you ask me that, I'm thinking, well, I'm talking about China, Ukraine, supply chain, Biden. They're all a big deal. If in terms of tragedy, probably the war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these learned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your ability to feed your family or keep a roof over your head. So people get inflation. One of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. It's like, hey, if I used to fill up my Ford F-150 truck for $50 and now it's $125, A, you get it. It's right in your face. And B, that's $75 that you don't have to take your spouse out to dinner, buy a new jacket or whatever. So there's kind of demand destruction at the same time you're spending more money on the one thing you can't do without. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming late this year, early next year. Now I say, we're in a recession. I mean, it's not coming, we're in it. And there's data. I never make statements like that, Brian, without supporting it. So the standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. And there's a lot of whistling past the graveyard. I mean, the stock market is still
greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, buy Netflix or whatever. And, there's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So you got to reverse engineer the 27-year-olds from Bangladesh who don't get out much. They're the ones really writing these algorithms. Brilliant engineers, but you'd have to show them around Wall Street. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on.
All right, so you're expecting a major correction in stock markets on the back of a recession.
I mean that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run hundreds of billions, and they're saying the same thing. So, so every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3 in the sense that it's real estate, stocks, and other asset classes. So I do. That is my view, but it's shared by a number of other analysts.
And that would mean like S&P coming off another 20-30%?
Yes. And again, you have to remind people. 1929, everyone's like, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was, it was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. That was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years, but that fell 82%, and that happens. So we're down. Nasdaq's down, bounced back a little bit in recent days, down close to 30%. Down, the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect.
Talk to me about inflation, because I was looking at some of the inflation numbers, and you have to go back to the 80s to see anything that's approaching double digit. I remember being just a kid hearing about double digit inflation. I could kind of remember the gas pumps, the lines at the gas. It's like a distant memory of me in the 70s. But how do you talk to younger people these days about what inflation is or it means? Because I don't think people really grasp what it actually means to your savings or to the economy in even a medium term.
Well, that's exactly right, Brian. And if you're a little younger than I am, but I lived through it. I started my career in banking in 1976, and I remember my wife and I used to kid each other. She was in advertising, I was in banking, and the inflation was so bad, you'd get a raise every 4 or 5 months, and you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and then I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed a TV set or refrigerator, new car, whatever, you say, I better buy it now because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Of course, gold was, going to the moon. There was a lot going on at the time. But Brian, you're right when you say we're putting up inflation numbers today that are the highest in 40 years. That is correct. A little 41. Actually, it was 1981 before we saw these numbers. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. It wasn't the beginning. It's like, that's some inflation. Yeah, we did, but it had started. In some ways it started in 1968 and it really took off in 1974, 75. So 81, these numbers, that was when Volcker finally got it under control. But you go back to 80, 70, between 77 and 81, so that 5-year period,
the dollar lost 50% of its purchasing power, not 15, 50 in that 5-year stretch. So you were putting up numbers, 10%, 11%, 13% and higher year after year. Yeah, 1981, it was 9 or 10, which is what they're comparing it to today. But that was on the downslope. It had been higher than that in 77, 78, and 79. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Or is it different than that? But keep that in mind, because the 40-year comparison, it is correct, but that was the tail end of an even worse episode. And again, there is this comparison to the 70s. By the way, I think the situation we're in today is very different from the 1970s, and I'll explain why. In the 70s, it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war, and then the price tripled, but it went from $2 to $6. Okay, but percentage terms, that's a huge jump, but it was still $6, and then it got to 12, and then in 1979 you had a second oil embargo because of Iran and the Ayatollah and the revolution and the hostages and all that. And then it went from kind of 12 to 20. So oil went up by a factor of 10 in the course of the late 70s because there's two different embargoes. So that's coming from the supply side. But what happened was the other source of inflation is on the demand side. So you have what's called cost push inflation. That's where supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described, and as I say, I lived through the 70s, where hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course they're related. It's like here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, etc. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation. If one of our supply chains or one of another country's supply chains that we rely on collapse, it could cause an unprecedented economic super collapse on a global scale. And that's how we could end up with this $85 trillion economic super collapse I'm predicting. $85 trillion being the value of the global economy. Because remember, our current supply chain is interconnected on a global scale. And if there is a single point of failure, the whole system is going to come collapsing down. Farming, banking, healthcare, oil and gas, tech, and so on. This isn't the first time I've warned Americans about this before. On May 11th, 2020, I told my followers, the economy will not return to normal for years. There are serious constraints on supply. I issued another warning about my research on November 24th, 2021. The supply chain difficulties will certainly grow worse. The remedies will take years and sometimes decades to implement. And yet another in 2022. Don't believe the happy talk about a temporary supply chain crisis. I'll say that again. The crisis will last for years with predictable negative effects on economic growth. But now things are even worse than ever before. And I fear this economic super collapse could hit American soil in the next 6 to 12 months. So this may be my last and final warning before it's too late. It's why I'm warning people around me it's only a matter of time before the world economy comes crashing down. Because when you talk about risk of catastrophic collapse, the risk increases with the size of scale. Look, whether you decide to listen to me today about how to prepare, whether or not you decide to get access to the information in this envelope, that's up to you. It's a free country. You can do what you want. You can even pretend you never heard me tell you any of this. But just know, Joe Biden certainly isn't going to come to your rescue. Take a look at this 9-second clip from the president.
When do you think things will get back to normal?
When do I think things will get back to normal? But my hope is by this time next year, we're going to be back to normal.
That clip was taken over 18 months ago. It's up to you what you believe. But I can't bury my head in the sand and ignore all the facts, and the facts couldn't be more clear. So in just a moment, I'm going to explain how you can get access to this information inside the envelope as part of my super collapse preparation package. And I'm going to talk about what to do to protect and even grow your wealth. Look, please understand, it brings me no joy to say this, and I hope the worst of what I'm warning of never comes to pass. But there's only one potential solution to this crisis, and it's going to take years. Recently, I spoke to a very well-informed CEO of a major corporation, and I asked him point blank, I said, "Your company must be looking ahead at some possible solution. Is there anything you can share?" Well, I'm going to tell you the same thing he told me. He said, "Jim, you have to understand that it took us 30 years to build these supply chains. We blew it up in 3 years, beginning in 2018, and you can't put it back together. But there is one thing we can do. It's not a quick fix, but it's our best and most sensible option. Our only way out is to build a new supply chain that eliminates the bad actors. We can't continue to allow our enemies like China or Russia or Iran to threaten consumers here on American soil. As the Wall Street Journal wrote, Russia's lengthening war with Ukraine will lead to a near doubling of inflation rates in rich countries. It's why the New York Times wrote, this is what happens when globalization breaks down. And why Barron's wrote, secure U.S. supply chains with allies and move out of China. Unfortunately, this solution could take years or even a decade to fully implement. And that CEO told me it will take at least 10 years to reconstruct the supply chains if we don't want to do it with China and globalization. But whether you realize it or not, that's the bet we're making as a nation. It's happening now. And when the dust settles, we're either going to have rolled out this new supply chain before worst case scenario happens, or we're going to face whatever lies ahead from this $85 trillion economic super collapse. Now maybe you're wondering how bad things could really get. Let me answer that question with another question. Do you remember your life at the beginning of the pandemic? Despite all of our freedoms we all hold so dear, an unelected official with the ear of the president recommended immediate lockdowns, and suddenly we heard demands like shelter in place or stay at home, backed up by the threat of arrest. Large swaths of the economy ground to a halt. Looting took over our towns and cities. Because so many businesses were shut down, people were emboldened to take to the streets. But if most Americans don't have access to enough food, water, or other necessary supplies, do you really believe our streets and our businesses won't see more violence? It's why gun sales keep hitting all-time highs as more and more Americans prepare for whatever lies ahead. And while I hope the worst of what I'm warning in my urgent new book never comes to pass, I don't suggest you rely on hope to protect yourself and your family. I'm certainly not. Here's how I'm ensuring my family's well-being. First, I would suggest stocking up on essentials, just like I've done. I have a fully finished area in the basement of one of my properties, the address of which I keep totally private. It provides me with a warehousing area for months' worth of canned foods and other non-perishable provisions. That's important. Don't stop with a 3-day supply like the CDC recommends. Make sure you have enough water, basic food, and toiletries to last at least 3 months. And keep them in a safe area where they can sit without damage or spoiling. I would also recommend buying several large capacity freezers. I already have 3 and I may continue purchasing more. If you have the means, consider installing alternate energy solutions in case of a worst case scenario. I've already installed the largest non-commercial solar power system in New England on my property. If you can, have alternative sources of power generation on your property. I've also dug 3 wells, planted abundant gardens, and built a significant greenhouse. But whatever you decide, do recognize that none of it will matter if you're not getting accurate information about what to expect in the coming days. Like I said, to be able to make the right decisions during a crisis, you need to lean on someone. So if that's not me, you should find another well-connected person you can trust, ideally someone who's previously held a position of power in our government. But if you want to learn what's inside this envelope and see what I know, right now is your chance. See, I've gone ahead and published this information I'm holding here in this envelope inside my newest book. It has brand new proof of the unfolding situation and inside level details on how it will play out. Urgent Preparation Report number 1. Buy this asset after securing your family's food and energy. As the economy collapses and the shelves are bare, the government will respond by printing even more money. When it does, the value of the dollar will be destroyed through inflation. But 5,000 years of history proves that one item, gold, outlasts every other currency as a form of money. And I believe that economic collapse occurring right now will send gold skyrocketing over the next 6 months. That's why I'll send you my urgent report called The Perfect Physical Gold Portfolio. Everything you need to know about buying the right kind of physical gold as part of my super collapse preparation package. You'll find everything you need to know about investing in gold before the price blasts through the ceiling, including, is gold safe to invest in? How much should I invest in precious metals? What metals should I buy and what should I avoid? What are the best places to buy gold and other precious metals? What are the safest ways to store gold to avoid theft or government confiscation? And much more. Plus, I'll also send you Urgent Preparation Report number 2, my Biden Bucks Protection Plan. I haven't mentioned it yet, but during my research, I came across a troubling executive order that President Biden just signed. See, every time there's an economic crisis, the government responds with massive new programs to try and control the economy and its citizens. In 2008, it was bailouts of big banks and new government agencies to regulate the financial industry. This time, it will be much worse. I've uncovered a plan for U.S. government cryptocurrency I call Biden Bucks that I believe the government will unveil during this economic collapse to control your money and manage the societal fallout. By the time this program is announced, it will be nearly impossible for everyday Americans like you to protect their wealth and keep their privacy, which is why I've created another urgent report to get you prepared ahead of time. Inside this new report, you'll get step-by-step details on what these Biden Bucks are, why they'll be used during this collapse, and how to outsmart this sinister program by creating, 1, an off-the-grid fortune, secure $1.1 million in wealth inside a soda can safe. 2, saving your freedoms, have liquidity and spendable wealth without using Biden Bucks. And 3, growing your personal wealth. You'll get possible investment upside as events unfold. And 4, ensuring you maintain your wealth regardless of external conditions. Building your own off-the-grid portfolio now will protect you from the government surveillance state coming during the economic super collapse. Biden Bucks testing is underway. The digital dollar could be rolled out soon. Before it's too late, make sure to protect yourself and your retirement savings. You'll find everything you need in this urgent report as part of my super collapse preparation package. But that's not all, because you'll also get urgent preparation report number 3, secure this secret off-the-grid asset. You see, I've learned of another little appreciated asset that's a liquid form of wealth. It can't be tracked or traced. It's completely legal and easy to find if you know where to look. Over time, its value has steadily grown, but very few people know anything about its investment potential. You're about to be one of the few. I believe you must include this secret asset in any off-the-grid portfolio. We're in a recession. I mean, it's not coming. We're in it. It's a triple, greatest bubble of all time, times 3 in the sense that it's real estate, stocks, and other asset classes. The largest, most sophisticated, biggest player, real money market in the world is telling you that the Fed's going to blink, that they're going to raise rates, and then things are going to get so bad, they're going to have to cut rates. And that's why we can see a liquidity crisis and a very severe recession coming well in advance. I haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is going to play out. It'll get worse as the year goes on. Inflation was going up long before the war in Ukraine started. So if everything is great until February 27th, and then Russia invades, and then all of a sudden the inflation goes up. All right, let's talk about it. But that's not true. This inflation goes back to late 2021. It was persistent in the fall. We all remember the Fed and the Treasury saying transitory, 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 and then finally, I think Jay Powell was testifying before Congress. He said, it's time to retire the word transitory. So that was his way of throwing in the towel. And Janet Yellen admitted she was mistaken also. This is going to be part of what throws the economy into severe recession. They're raising rates and inflation's coming down. But what they don't know is, are interest rates coming down because they're raising rates, or have they already hit the terminal rate and it's coming down on its own and they just don't know it? And that's a big deal, because if they're at the terminal rate and they just don't know it and they keep tightening, which they are going to over tighten, probably already have. The energy prices are going up because there's a war with Russia. Well, I wonder why that is. Well, the reason is not because Putin invaded Ukraine, it's because the U.S. counterattacked with financial sanctions. Now, bear in mind, go back to January 21st, 2021, when Biden was sworn in as president, and then went back to the White House. What was the first thing he did? He closed the Keystone XL pipeline. This is a pipeline that would bring oil from Alberta, Canada, into the United States, where it would connect at a hub. I believe it's in Kansas, but somewhere in the central United States. And then the hub distributes it to the entire country. So he shut down that pipeline, which curtailed the supply of oil from Canada. And then we end up with oil prices doubling or tripling, really, from $40 to $120 in under a year. The other source of inflation is on the demand side. So you have what's called cost push inflation. That's where supply is choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described, and as I say, I lived through the 70s, where hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So inflation is coming down, no question. But is it because the Fed has continued to raise rates, or is it because the Fed has hit a terminal rate and all they have to do is nothing, just pause, as they put it, and inflation will come down where they want? The market believes we're at the terminal rate. The Fed should just stop right now, leave it alone. Sooner than later pivot to, that's the new buzzword, pivot to rate cuts. And it's the anticipation of those rate cuts that has Wall Street all spun up. They get the pom-poms out and saying, buy stocks, buy tech, because the Fed's going to cut rates. The Fed does not see it that way at all. The Fed says, yeah, we're raising rates, inflation's coming down, but we're not at the terminal rate. We'll kind of know when we see it, but they think it's probably 5.25. That's a very good estimate based on what the Fed has said themselves. I started my career in banking in 1976, and so I remember my wife and I used to kid each other. She was in advertising, I was in banking, and the inflation was so bad, you'd get a raise every 4 or 5 months, and you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and then I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed whatever, a TV set or refrigerator, new car, whatever, you say, I better buy it now because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power. Not 15, 50. During the first part of the Great Depression, unemployment was high, output was dropping, trade was dropping. It was a very, very bad time, no doubt about it. But not everybody was out of work. Not everybody was poor. There were a lot of people with a lot of money at the time, but it was felt that being ostentatious was poor form. It's like, okay, I'm lucky I have a job, I've got some money, but I'm not going to buy a new car, buy a big house, or flash it around or whatever, because it's really not considerate of all the people who actually have fallen on hard times. Well, that was the narrative, but it's the worst possible economic advice, because it's precisely the fact that people with the money should keep spending that kind of can boost the economy out of a depression. So by people saying, well, even though I have the money, I'm not going to spend it because it's poor form, we're actually prolonging the Great Depression. Today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food, you got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, etc. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation. We're not quite at the stage where it's demand pull. We're not quite at the stage where individual consumers are behaving the way I described in the 1970s, saying, hey, better spend the money fast because it's losing value. This damage was self-inflicted, but don't be misled by the headlines because they're, again, this narrative, but they're not actually doing it. So the point being, the price increase and the inflation in the U.S. has very little to do with Putin and everything to do with the U.S. handicapping its own energy industry, begging dictators for oil, and the influence of the climate alarmists. And by the way, that whole crowd want higher gas prices. They want gas to be $7, $8, $9 a gallon because they expect that will accelerate the transfer to electric vehicles and make the electric vehicle more attractive relative to the internal combustion engine. Now, that's another fantasy. It will never happen. But meanwhile, they're destroying the U.S. economy in pursuit of an ideological point that will never actually happen. People hear the government say, the economy's fine, or, unemployment's near an all-time low, which actually statistically is true. And they kind of nod and go, yeah, it's all good. And then reality is the stuff that hits you in the head like a 2x4. The propaganda is positive. We can talk about that in a little more detail. The reality is harsh, and reality wins. And there's a very good book on this by Robert Shiller, Nobel Prize-winning economist at Yale University. I'm not a huge fan of your garden variety PhD economists, but there are some good ones out there, and he's one of them. He wrote a book about, 2 years ago, maybe a little bit less, called Narrative Economics. He said, we got all the models and Phillips curve and wealth effect and various quantity theory of money, and some have a place, some are more valuable than others, but don't underestimate the power of a narrative. A narrative is a story. It's basically it's a fancy name for a story, but a story that persists, that grows. And interestingly, in epidemiology, of course, we've just come through a pandemic. There's a model called the SEIR model that stands for susceptible. Are you susceptible to a virus? E for exposed. Are you exposed to it? I, are you infected? Did you get it? And R, did you recover? The difference between I and R are people who died. But it's a model, and it's mathematically based, and it's empirically validated of how viruses spread exponentially. And you can also use it to forecast how a virus is going to go. Well, what Shiller did, he took that model, moved it over to economics, and took a narrative kind of like a virus, not in a negative sense, but just as something that spreads. And it can be very powerful, and then eventually may die out or reverse, but it can be powerful in the meantime. That much I knew, but what I learned from the book that I hadn't really thought about is that narratives don't have to be true. They can be true, and they can be very powerful, but a narrative can be false and still be powerful. If it's the self-fulfilling prophecy, if enough people believe it, it sort of becomes the reality to some extent, even if it's based on false premises. He gives an example during the Great Depression. The Great Depression really was two technical recessions, but there was a period from 1929 to 1933, election of Franklin Delano Roosevelt. And then there was another period from 1933 to 1937. The 37 and 1940 part we'll leave aside for this purpose. But during the first part of the Great Depression, unemployment was high, output was dropping, trade was dropping. It was a very, very bad time, no doubt about it. But not everybody was out of work. Not everybody was poor. There were a lot of people with a lot of money at the time. But it was felt that being ostentatious was poor form. It's like, okay, I'm lucky I have a job, I've got some money, but I'm not going to buy a new car, buy a big house, or flash it around or whatever, because it's really not considerate of all the people who actually have fallen on hard times. Well, that was the narrative, but it's the worst possible economic advice, because it's precisely the fact that people with the money should keep spending that kind of can boost the economy out of a depression. So by people saying, well, even though I have the money, I'm not going to spend it because it's poor form, we're actually prolonging the Great Depression. Now, when FDR came along, was elected in 1933, became president in 1934, the psychology turned 180 degrees, and all of a sudden, the The Democratic campaign song was Happy Days Are Here Again. And, FDR seemed to solve the banking crisis and so forth. And all of a sudden it became okay to spend money. Well, in the middle of the Great Depression, 1934 to 1936, those were some of the strongest years ever for the stock market. And unemployment did come down a lot. Now, the problem is it came down from like 25% to 15%. Well, 15% is still, painfully high, but it was a big move in the right direction. So he describes how the narrative flipped from don't spend money, it's poor form, to, go spend money and help the economy. None of that is taught in business school. It's not taught in economics. It can be modeled using this epidemiology model, but it doesn't fit into any of the standard macroeconomic models, but it's powerful stuff. And so today what's going on is that the White House is trying to push a narrative, and they're failing badly. But they'll say, if you listen to the deliberations among White House officials, some of the stuff leaks to the press, and I know some of these people. It's like the economy's great, unemployment's really low. We've created all these jobs since the pandemic, but we're doing a really bad job of messaging. The point is, they're inside the White House. They're frustrated that the positive economic story is not getting out. The correct analysis is that there is no positive economic story. The economy is in terrible shape. The problem is not the messaging, it's the message. And this is why I say the propaganda from the White House that things are great is at odds with the reality, which is things are not great. Let me give you some specific data points, because as I say, I don't like to make statements like this without backing it up. Number one, the inflation was going up long before the war in Ukraine started. So if everything was great until February 27th, and then Russia invades, and then all of a sudden the inflation goes up. All right, let's talk about it. But that's not true. This inflation goes back to late 2021. It was persistent in the fall. We all remember the Fed and the Treasury saying transitory, transitory, transitory. And then finally, I think Jay Powell was testifying before Congress. He said, it's time to retire the word transitory. So that was his way of throwing in the towel. And Janet Yellen admitted she was mistaken also. So it predates the war, number one. Number two, energy prices are going up because there's a war with Russia. Well, I wonder why that is. Well, the reason is not because Putin invaded Ukraine, it's because the U.S. counterattacked with financial sanctions. Now, bear in mind, go back to January 21st, 2021, when Biden was sworn in as president, and then went back to the White House. What was the first thing he did? He closed the Keystone XL pipeline. This is a pipeline that would bring oil from Alberta, Canada, into the United States, where it would connect at a hub. I believe it's in Kansas, but somewhere in the central United States. And then the hub distributes it to the entire country. So he shut down that pipeline, which curtailed the supply of oil from Canada. Then ended new leasing, oil and gas exploration leasing of federal lands, handicapped the fracking industry, took a number of other steps using environmental tools, climate alarm, government subsidies, et cetera, to basically, to the extent possible, shut down the U.S. energy industry as much as possible. Now, you can't shut down completely, of course, but everything happens at the margin. And then we end up with oil prices doubling or tripling, really, from $40 to $120 in under a year, which is comparable to what happened in 1973 with the Arab oil embargo. And then Biden wakes up and says, guess we need more oil. And he wants to reopen leasing. I said they shut it down. They did, but he wants to reopen it. He's begging Saudi Arabia to pump more. Saudi Arabia is kind of not returning his phone calls. He's begging Venezuela to pump more. Oh, great. The greatest pariah dictator in the Western Hemisphere, and we're begging him for oil. So why don't we drill our own oil? Because we were a net exporter up until 2021, and then Biden came in and we lost that edge and became a net importer, including recently buying oil from Russia. They curtailed that for political reasons, but that's kind of where we got to. So you wonder why the price of energy is going up. In other words, this damage was self-inflicted, but don't be misled by the headlines because they're, again, this narrative, but they're not actually doing it. So the point being, the price increase and the inflation in the U.S. has very little to do with Putin, and everything to do with the U.S. handicapping its own energy industry, begging dictators for oil, and the influence of the climate alarmists. And by the way, that whole crowd want higher gas prices. They want gas to be $7, $8, $9 a gallon because they expect that will accelerate the transfer to electric vehicles and make the electric vehicle more attractive relative to the internal combustion engine. Now, that's another fantasy. It won't happen. We don't have time to go through all the physics of it. And, you know, output of energy by weight, gasoline compared to batteries, and the pollution of batteries, and the fact that, we don't have the charging stations. And even if we did, where's that electricity coming from? Oh, coal. It will never happen. But meanwhile, they're destroying the U.S. economy in pursuit of an ideological point that will never actually happen. Another example of propaganda versus reality. You know, narratives are powerful, but reality is more powerful.